In 1368, when Mongol armies retreated from China and the Ming dynasty rose to power, something extraordinary happened in the markets of Beijing. Foreign merchants who had traded silver for centuries suddenly found their currency worthless. The new emperor had decreed that only Chinese copper coins would be accepted for trade. But within months, those same foreign merchants were back, richer than ever, trading with instruments that looked like simple pieces of paper. The Chinese had just weaponized trust itself. This is another video where money, power, and history collide, and nothing is ever as simple as it looks. The story we tell ourselves about ancient Chinese banking is neat and simple. China invented paper money during the Song dynasty in the 11th century. They created credit systems that allowed merchants to trade across vast distances without carrying heavy coins. They built the foundation for modern banking centuries before Europe caught up. That version is true. It's also incomplete. What history books don't emphasize is that Chinese bankers didn't just create financial instruments. They created the world's first system of economic warfare. They understood something that wouldn't become clear to Western powers until the 20th century. Whoever controls the medium of exchange controls everything else. The real story begins with the Xiongxi merchants, a network of banking families from northern China who operated from roughly 1400 to 1900. These weren't just traders. They were financial architects who built an invisible empire that stretched from Beijing to St. Petersburg, from Mongolia to Southeast Asia. The Xiongxi system worked like this. A merchant in Canton could deposit silver with a Xiongxi bank and receive a piece of paper called a fipio, or flying ticket. That paper could be presented to any Xiongxi office across Asia and exchanged for local currency. No physical money needed to move. No caravans needed to carry heavy metals across dangerous routes. It was elegant. It was efficient. It was also completely opaque to outsiders. The Xiongxi banks didn't publish exchange rates. They didn't explain their reserve requirements. They didn't even acknowledge that they were setting monetary policy for half the known world. European traders who used the system thought they were simply paying for convenience. They didn't realize they were funding a financial network that reported directly to the Chinese imperial court. The genius was in the structure. Each Xiongxi bank was technically independent, family-owned and operated. But the families were connected through centuries of marriage, shared religious practices, and most importantly, a common accounting system that treated all Xiongxi banks as branches of a single, invisible institution. When a Russian fur trader exchanged his fipio for silver in Kyokhta, the transaction was recorded not just locally, but in ledgers that traveled back to Pingyao, the spiritual capital of Xiongxi banking. The Chinese weren't just facilitating trade. They were collecting detailed intelligence on every significant commercial transaction in their sphere of influence. The system gave China something unprecedented: real-time economic surveillance across multiple continents. European colonial powers were still moving gold and silver physically, still thinking of money as a physical commodity that needed to be hoarded and protected. The Chinese had moved beyond that centuries earlier. They understood that money was information, and information was power. When the Dutch East India Company wanted to buy Chinese tea, they had to use Xiongxi bills of exchange. When Russian merchants wanted to trade in Chinese border towns, they deposited their furs with Xiongxi banks. When Southeast Asian spice traders wanted to access Chinese markets, they submitted to Xiongxi credit checks. The Chinese weren't just participants in global trade. They were the invisible central bank for half the world's commerce. The most sophisticated part of the system was its currency manipulation mechanisms. The Xiongxi banks didn't just exchange money. They actively managed exchange rates to benefit Chinese interests. When foreign demand for Chinese goods was high, exchange rates would mysteriously shift to make Chinese exports more expensive. When China needed foreign silver, rates would adjust to encourage imports. European merchants noticed the fluctuations, but attributed them to market forces. They didn't realize they were experiencing the world's first coordinated monetary policy designed by a foreign power to extract maximum wealth from international trade. The Xiongxi bankers perfected something modern economists call asymmetric information warfare. They knew more about global trade flows than any government, any company, any individual trader. They used that knowledge to position themselves at the center of every profitable transaction, while remaining nearly invisible to the foreign powers who depended on their services. But the system contained the seeds of its own destruction. The Xiongxi Bank's power depended on China, remaining the world's dominant economy. As long as everyone wanted Chinese goods, more than China wanted foreign products, the Xiongxi could dictate terms. But by the 19th century, that balance was shifting. European industrial production was growing. British textile mills were producing cloth that could compete with Chinese silk. European military technology was advancing faster than Chinese defenses. The economic leverage that had made the Xiongxi system possible was eroding. The Opium Wars of the 1840s and 1850s didn't just force China to open its ports to British trade. They broke the Xiongxi monopoly on financial intermediation. British banks established branches in Chinese cities. European currencies became acceptable for transactions that had been exclusively Chinese for centuries. The final blow came with the telegraph. The Xiongxi Bank's competitive advantage had always been their superior information networks. They knew about price changes, political developments, and market opportunities before anyone else. But telegraph cables could transmit information faster than any human courier. The technological foundation of Xiongxi dominance disappeared almost overnight. By 1900, the great Xiongxi banking houses were either bankrupt or reduced to serving purely domestic Chinese markets. The families who had once controlled international trade flows became local moneylenders. The system that had shaped global commerce for 5 centuries vanished so completely that most economic historians barely mention it. The names have changed. The behavior hasn't. When American politicians complain about Chinese currency manipulation today, they're describing a strategy the Chinese perfected 600 years ago. When economists worry about China's dominance in global supply chains, they're witnessing the same asymmetric information warfare the Xiongxi banks used to control medieval trade routes. Modern Chinese financial institutions still operate with the same strategic patience the Xiongxi banks demonstrated. They build systems that appear to serve everyone's interests while positioning China at the center of all significant transactions. The Belt and Road Initiative follows the same playbook the Xiongxi banks used to establish their network: offer indispensable services, collect detailed information, and gradually make other countries dependent on Chinese financial infrastructure. The difference is scale. Where the Xiongxi banks managed thousands of transactions, modern Chinese financial systems process millions. Where the Xiongxi banks influenced regional markets, modern China shapes global currency flows. The principle remains the same. Whoever provides the essential financial infrastructure gets to set the rules for everyone else. The Western banking system we consider normal today, with its emphasis on transparency, published interest rates, and regulatory oversight, is actually the historical exception. For most of human history, banking worked the way the Xiongxi banks worked: secretive, family-controlled, and designed to extract information as much as profit. We built our modern financial institutions on the assumption that transparency and competition would prevent the kind of manipulation the Xiongxi banks practiced. But we built those institutions during a period of Western economic dominance. As that dominance fades, older patterns are reasserting themselves. The Xiongxi banks understood something we're only beginning to remember: money is never neutral. Every financial system serves someone's interests. Every currency reflects someone's power. Every transaction generates information that someone can use. The greatest trick the Xiongxi banks ever pulled was convincing their customers that they were providing a service rather than collecting a tribute. The greatest trick modern financial systems pull is convincing us that economic neutrality is possible at all. Trust isn't created by transparency. It's created by necessity. And necessity, as the Xiongxi banks knew, can be engineered.